Good morning and welcome to the eStar Resources PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Alex Walker, CEO. Good morning to you, sir.
Good morning. Thank you very much for having me, and really thanks for everyone joining us this afternoon in the UK.
Alex, over to you for the presentation. Thank you.
Thanks. Okay, so I've got our standard presentation our updated presentation, which was just released to the market today, that I'd like to go through. Before I do, we haven't historically talk too much about commodities and commodity prices and so on. We've been really focused on the quality of our exploration, the quality of our assets, and the exploration success that we've had. But it's a really important time at the moment to talk about copper and the copper market. Everyone's aware of obviously this transition to net zero and a non-fossil fuel based energy system. And how much I think the vast majority of the world even today understands that copper makes up a huge part of that transition. We can all sort of quote numbers about an EV having something like 15, 20 times more copper than a regular vehicle, and an electric bus is something like 50 times more copper. But what is really, really important as well is copper can't ramp up to call it that, like lithium can, for example, to help meet that demand. There's not 600 years worth of copper sitting in brines that's just waiting to be extracted, and it's an exploration infrastructure driven play. These are assets that have significantly depleted mine lives, falling grades. And until about a month ago, there was a prediction, from most of the big banks and the big mining players, BHP and the like, that there'll be a copper deficit by 2027, which is only 3 years away. What's happened in the last month is actually some fairly significant events that could well bring that forward to 2025, even 2024. We've had Cobre Panama essentially close with First Quantum, which brings several 100,000 tonnes out of the market. We've had issues, we've had downgrading from Anglo by around 200,000 tonnes. Other production issues with Codelco in Peru and Chile. And so we are very much staring down the barrel of a copper deficit in potentially in 2024. And that's quite critical, because obviously lots of these assets, lots of these these potential production assets, if they're sensible like us, they're using spot copper prices. But the sensitivity to a change in copper price can be really significant. So if you're valuing a project today at around $8,000, $8,500 a tonne, by the time someone like us could be in production in a few years' time, we could comfortably be staring down the barrel of $12,000, $13,000, $14,000, $15,000 a tonne. So there's quite significant leverage to the copper price. And I think if you don't already find a way to get copper exposure in your portfolio, even with the large caps and so on, because I think that's going to be a real thematic for 2024, 2025. So on to eStar and why you should get that copper exposure via us. So we're a London-listed company. EST is our code, trading on the main board of the London Stock Exchange. We've been listed for just under 2 years. We are a Kazakhstan-focused company. The reason we're in Kazakhstan is because basically I felt like this was a once-in-a-lifetime opportunity. We did a top-down thematic, many years ago when we were looking at different jurisdictions, and Kazakhstan is nearly 2.7 million square kilometres, which is about the size of Western Australia. It's bigger than Western Europe. It had changed its mineral law in 2018 to match that of Western, or to be modelled, I should say, off Western Australia's. So it now applies first come, first served principles. And it's drastically underexplored. There's been lots of mapping and so on during the Soviet era, but basically for 50 years, there's been almost no discoveries in Kazakhstan. And that's principally because there's been no real exploration, in particular undercover, using modern exploration techniques, deep analytics on geophysics, and so on. So we find that opportunity really, really exciting, and we hope that we'll be at the forefront of making those discoveries. That's backed by other major players. Rio Tinto's been here for some time. Fortescue Metals Group out of Australia has came to Kazakhstan almost exactly the same time as we did. Also at the same time signing a joint venture with the national mining company Talcan Samruk. And very recently we've seen groups like First Quantum Minerals and Barrick say that they will be starting exploration in Kazakhstan as well. So it's starting to become a very, very exciting jurisdiction that's attracting most of the majors who aren't here already. I should add the EU and the UK have signed MOUs for critical mineral supply with Kazakhstan, which they've only done with a handful of countries. And outside of the geological potential to find these minerals and produce them, principally it's the political will to develop them. And that's absolutely key, because you are talking about very short, refined permitting processes in Kazakhstan, whereas something in North America or in Europe, if it ever gets permitted, might take a decade. And I think that's really critical and a huge selling point for the country. Today, and principally because this is what we've been doing this year, we're focusing on our assets in the Rudny Altai volcanogenic massive sulfide belt in the east region of Kazakhstan. It's a hugely exciting mineral belt. It's the fourth biggest producing VMS belt in the world, and certainly in our view, probably one of the least explored. It's got over 1,000 million tons of ore, goes for 800 kilometers, about 300 of which is through Kazakhstan into Mongolia and into China. And there's huge gaps in where theoretically, statistically, there should be additional discoveries having been made. And we've certainly pegged our licenses cover one of those significant gaps, about 30 kilometers in between a small cluster of ore deposits. Of very, very high grade, very exciting and profitable mines. There's 3 mines in our part of the belt that are producing today, and dozens of historical producing mines. One is just to the southeast of our license called Otiskoy, which you can see there, and one to the northwest called Artemyevsky, which you can see in the top left. Now, they both produce ore and send it to the Kaz Minerals concentrator, the Nikolovskoye concentrator, which you can see marked on the map. And that concentrator is about 52 kilometers from our Vakuba deposit, which we have an exploration target of 19 to 23 million tons at 1.4 to 1.9% copper equivalent, most of which of that, by the way, is copper. And we have recently been drilling that, which I will get to shortly. Within our license package, we've got another few high priority prospects, Talovskoy, which I'll touch on today, which we released some rock chip samples for previously. There are a few small past operating mines and deposits which sit on the license and we need to look at the potential of. And also, as I mentioned, there's over 30 kilometers of strike along this Erta shear zone, which we believe has the potential to find another Artemyevsky of 50 million tons at 4 to 6% copper equivalent. So it's a very, very exciting region. It's infrastructure rich. The Kaz Minerals concentrator today has spare capacity, as does the Kazzinc concentrator, which is 70% owned by Glencore. Both of those have spare capacity today to take additional ore. And that's why we're really excited about the potential for a quick, low-cost development option. A little bit about the deposit. So we pegged this deposit in the middle of 2022. We then went into collecting a significant amount of data. It takes quite a lot of time to collect all of the data and then digitize and analyze. So we did that for about 8 to 12 months. And when we put the whole thing together, we handed the data over to an independent contractor called AMC Consulting out of Perth, very, very highly respected contractors. And they basically came up with this. It was the exploration target and modeled pit shells. The whole concept of handing it to them was, is this worth spending money on drilling? And the answer came back with a very resounding yes. More than 42,000 meters of drilling was digitized. They had copper, zinc, and lead grades. No silver or gold in the historical drill reports, but there was certainly some silver and gold that reported to concentrate with the metallurgical test work that was done in the 1950s and 1970s. So all of that basically came up with the exploration target that you see there. As I said, 19 to 23 million tonnes at 1.4 to 1.9% copper equivalent. So in the medium grade, that's around 300,000 tonnes of contained copper, which today is worth over $8,000 per tonne. Now, AMC also put a net present value based on an optimised pit shell on that. The base case was $241 million. That's pre-capex number. So typically, for if you're building a concentrator and building all of the facilities, you'd be looking at a number in excess of 100 million. So that should be factored in. But points to note is that is the open pit only, which is only 5 to 6 million tonnes of the 19 to 23 million tonnes. So it's less than a third of the deposit. And on top of that, we believe there's the option for toll treating or mine gate sales of crushed ore. And so you potentially aren't staring down the barrel of $100 million capex. You're staring down the barrel of something much, much, much lower. So we find that all incredibly exciting and incredibly compelling economics to continue with this project. So we set about drilling it this year. And obviously the intent of that drilling was to test the historical work. The first thing we do when we're assessing a project that someone's showing us is, have you got any core? Can we have a look at it? And so obviously the same question is asked of us and the same question of ourselves. How accurate is this historic data? So we set about testing that this year. We drilled 5 holes into the Vakuba deposit proper. And you can see the results there today, which we are absolutely over the moon about. It confirmed very high grades of copper, very shallow copper, and therefore the open pit potential that we've been talking about, which is within the optimized open pit shell that were done by AMC previously. And it's got a number of mineralized, what we call mineralized lenses, which is sedimentary hosted lenses, which has now been traced over several hundred meters width between drill hole 1 and drill hole 3, which you can see there. And then drill hole 4 is interpreted to be on the other side of a fault, which is a little bit lower. I'm also very, very excited by drill hole 4 because the grades were very thick intersections and very, very good grades. So if you can think about this from the perspective of an open pit would finish at the end where that fault lies, well, then you're already most of the way down to where you might look at starting an underground operation. So you don't have 300 or 200 or 300 meters of decline that you need to build. You might only have 60 or 70 meters. So that does very much open up the potential of going underground at the end of an open pit mine life. So we're really excited by these grades. This very much demonstrates to us we have open pit potential, underground potential as well to extend the mine life in due course, and something now we intend on getting completely stuck into next year to move through the process of converting it to JORC resource and feasibility. Something else I should note is the resource envelopes were considerably wider than what had been modelled previously. We've used a very conservative cutoff grade of 0.38% copper equivalent. And for our intersections, we also use very conservative recoveries on zinc and lead and silver. As I said, more than 95% of the economics typically has been copper. But for some of the deeper ones, so for example, the drill hole 2 that just sits on the other side of this fault, there's some very, very good zinc grades in there as well, up to 6.6% zinc. And so with our copper equivalent grades, we've been very conservative with the zinc recoveries of only 70% of that. Again, the historical metallurgical test work gave better recoveries than 70% on zinc. So we believe that our modelling has been incredibly conservative, and yet we are still very, very, very excited about the option, the potential to develop this project. A little bit on Talovskoy, which is another target within the 803 square kilometre package, which we released samples for recently. Historically mined, it's a hill that's sort of covered in what we call scree, which is the extra material that gets taken out from a mine shaft. Lots of oxidized copper at surface and big chunks of massive sulfide as well that are rare but are still there from the pipes that have been mined previously, about 6 or 7 very, very high grade pipes that have been mined previously. And you can see the sorts of grades that have been sampled both on those pipes, at the edges of those pipes, and also the Gossan material, which is what we call disseminated ore, which sits on the edges of this material. So we don't yet have a good concept, a good geological model of what this is. It's being put together at the moment with historical data. There has been some drilling showing, 1+% copper grades at depth, fairly shallow, but obviously separate to the mine shafts. And so we think that this is a really, really exciting opportunity as well, which we'll look to drill as soon as possible early next year. The mine grades, the grades that you can see are absolutely mind-boggling, and so I'm not expecting those exact grades in drilling, but nonetheless it shows the potential of this region. And it's also only 17 kilometres from the Cas Minerals processing plant, so would be a very, very low cost, easy trucking option should it get to that point. We're not just resting on those, and really the original reason we came to the Rudny-Altai belt was to find another Artem Nevsky, find another 20, 30, 40 million tonne deposit or 50 million tonne deposit at 3 to 6% copper equivalent. And we still vehemently believe that there's one or several of those on our license package. In fact, we've had a chap called Dr. Bruce Gamel, who's probably the world's most preeminent VMS expert, geological expert, write a report and completely agree with us on the prospectivity of our license package. And so that's incredibly exciting for us. We did a heliborne EM survey to try and make those detections and start to refine the license area and the target areas. And since that survey, which came up with about 49 different targets, we've been refining those with geological field work, some IP work and so on to make those drill ready as well. And so we're not going to rest on Vakuba and rest on Taloskoy. We very much intend on progressing these with thorough methodical field work, sampling to make these drill ready and look to drill some very, very exciting targets, hopefully towards the end of next drill season. One of those things we did was an IP survey, and we've already got 3 very, very strong targets off the back of that. So once we confirm that they're in the correct mineral horizon, then they will become immediately drill ready. And so that's something that, we hope to do into next year. Principally why we focused on VMS systems are very, very high grade. And that's one of the key things to recognise here. They're very high grade. The recoveries tend to be fairly simple. They're polymetallic, so there's lots of credits involved, which means your operating costs are very, very low on a per tonne basis. And so it has an incredibly high return on invested capital. And that's why we're making the statement that global companies start with VMS. Rio Tinto started in 1873 by restarting the Rio Tinto VMS operation in Spain, which is in fact still operating today. Boliden made a VMS discovery in 1924, which is the Boliden deposit in Sweden. It is now a multi-billion-dollar behemoth. Lundin Mining, exactly the same in Sweden, a discovery in 1997, and is a multi-billion-dollar empire today as well. And Sandfire is a big one from a listed company, Australian listed company perspective, and just looking at that share price return, which was absolutely phenomenal with the De Grasser discovery in 2009. Sandfire today is a multi-billion-dollar company. So we think that this is a really, really clever way to start a junior company. It doesn't have $1 billion capex. It's very, very achievable. And so global companies start as VMS, start with VMS deposits. So this is a summary of what we've done this year. Focusing in the last quarter, it's the exploration results from Vakuba. We're still waiting on the gold results. I'm not expecting multiple grams per tonne. I'm expecting small credits to be added to help punch out the grades and add that as an extra credit to what we might be producing. So we'll be hopefully updating the market with the all-in grades at some point in time, potentially this side of the new year. We've released the Taloskoy results, and we're looking at doing an updated resource model. Likely that updated resource model will come early in the new year rather than towards the end of the year. And then we've already commenced planning for next year, so we'll be doing that more thoroughly through the winter break. But inherently, we want to get on the ground drilling Vakuba as quickly as possible, converting this to a JORC resource at inferred and indicated status. There is the potential that we'll be able to convert the open pit to a JORC resource with the drilling we've already done. But we need to assess the geostatistics of the work we've done against the historical work to see if that is the case. Regardless, we would very much like to progress this to an inferred or indicated resource status, which would then allow us to put a preliminary economic assessment on the deposit and look at applying for our mining license. So that'll be the focus for 2024. All the while, we'll progress a lot of our other field targets to make those drill ready as well. So it would be fantastic if we can, on top of drilling Vakuba next year, we can be drilling Talovskoy and a couple of other targets which have demonstrated very, very high prospectivity. So that's what we hope to be doing throughout 2024. Very, very exciting in terms of progressing a project and putting economic numbers on it, but also very, very exciting from a discovery perspective, which is which is what we're here to do in addition to developing our brownfields projects. There we are. Our company, well, we've used 1.33p. It's a little bit variant at the moment. I think it's 1.2p today. It's been up to 1.6 recently. But 2.9 million quid market cap, which is, saying a fraction, it would be a fraction of the value of the deposit on a developed basis in the ground. So we find that incredible leverage, really exciting. As I say, not to mention the leverage to the copper price. If we're not using $8,000 a ton, but we're using 12,000, by 2025, 2026, then those numbers can change very, very dramatically. We're highly committed to making this work. I've participated in every capital raise for the company, including IPO at 5p and the most recent round at 1.5p. I live here in Kazakhstan with my family and don't intend on changing that anytime soon with the potential that we're seeing in front of us. So we're really, really excited by the opportunity. We think that Kazakhstan remains once in a lifetime opportunity. And we think that East Star is probably the most fantastic way to get leverage to that. So there we are. Thank you all for your time. That was just over 20 minutes. Very happy to take questions now.
Perfect. Alex, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while Alex takes a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Alex, as you can see, we received questions throughout today's presentation. And if I could ask you just to read out those questions and provide a response, then I'll pick up from you at the end.
Certainly. Okay, so question number one is Camel, which is Central Asia Metals, mentioned in their interims they're looking at early exploration investments, which also mentioned site visits. Have they approached EST? Okay, good question. So East Star have a few companies in the data room in the past, quite a few companies in the data room in the past and presently. What I see is two major hurdles to closing a deal with a Central Asia Metals or someone like Central Asia Metals. The first in the past is technical due diligence. We have, I mentioned it during my presentation, one of the first questions you ask when you're looking at a deposit is, can I see the core? And we haven't had any. We've had detailed historical data. We now do have core, and so that has been remedied. So we would expect to fix that as a hurdle as of today, in fact, or as of this week. The second one, which is quite a major one, is valuation. So we have a market cap of, as I said, £3 million, less than £3 million, but our asset in Vakuba, just Vakuba, and none of the other assets in the portfolio or the exploration assets being valued in Rudny Altai is worth at least potentially 40 to 80 times that, just the open pit. And that's using the NPV numbers. 40 times would be half the NPV number that AMC put out in their independent report. So when you have that disconnect between the value, what we feel is the value of our asset and the value of our company, and when we're having conversations with other parties, we don't think that the premium, or certainly in the past, the premium hasn't been offered that deserves that potential not change of control, but influence that gets exerted by third parties. I'm not trying to pretend that we should be a $100 million company today, but certainly when you are looking at strategic investments, you need to be looking at a premium for that because of the value of the work that's been done, because of the value of the asset, and because of the influence that can be exerted as a major shareholder. So that's ultimately why we haven't closed anything to date. And I'm not mentioning names on any front on that, but that's why we haven't closed anything to date. And that will still be, our focus going forward is ensuring that shareholders get that value as best as possible. I hope I've answered that question, albeit danced around it a little bit. Question number 2, you've mentioned recently CapEx for Vancouver would be $10 million max. Can you confirm if this can be done solely via non-dilutive sources like debt trade financing? Well, to be absolutely clear, I've been providing very ballpark CapEx numbers. So this is not based on any economic feasibility work that we've done on this project because we're not there yet. I would love to be there by the end of next year, and that's certainly what we'll be targeting. So I just want to be very clear on that 10 million max figure is a ballpark number, and it's intended to demonstrate that toll treatment or mine gate sale situation, which is a reasonable likelihood for East Star. The CapEx number would be a fraction of the CapEx required to build a standalone facility, which, as I mentioned during the presentation, would probably be comfortably in excess of 100 million. So that's the intention of putting those very, very ballpark numbers in place. We would have, as an operation based on these drill results, a very limited pre-strip because the ore body starts within just shy of 20 meters from surface. It potentially goes higher. We're yet to drill that side of it. So very limited pre-strip to get to the initial ore. Little upgrade to infrastructure because of where we sit in Vancouver. We have roads coming to site. We have power coming virtually to site. We have water, less than a kilometre away. So most of the infrastructure is very much in place. We're not building hundreds of kilometres or even tens or fives of kilometres to run the facilities. So that's a huge amount of the pre-capex that gets taken away as well. And then what happens after that is we need to do the economic trade-off studies for, depending on what our offtake scenario is. Do we sell our run-of-mine or whatever that grade comes out as, run-of-mine grade, by crushing it, putting it in a truck and taking it straight to another facility? Do we try and upgrade it a little bit using maybe a dense media separator or an ore sorter to send maybe 4 or 5% copper concentrate to a facility? Do we build a more significant plant, a float circuit, and spend tens of millions or into the 100 to put together a copper concentrate, which ultimately would probably go straight down the road the other way to Uskamenogorsk, only 70 kilometres away to the smelter. So we've got to do all of those trade-off studies, and once we understand that, then we'll get obviously a better idea of the intended capex. The second part of the question, that's all around the $10 million answer. The second part of the question is about debt trade financing. Again, it's very early to talk about this, so I'll talk in holistic terms. Someone who has a Master's in Mineral Economics and Mine Finance, so I can talk very generally about how to finance mining operations. It's rarely done on completely non-dilutionary basis. I would say that debt to equity ratios in financial models for single asset development companies would be in the range of 60-40 or 70-30 debt to equity. The 40 of the equity and the 30 or 40 of the equity can be partly bridged. You can use bridge financing facilities, you can use royalties, and you can use prepay. So I think ultimately you need to have a look at what the options are on the table at the time and the cost of those options. So I'm not saying it would be 100% non-dilutionary finance, but it might also not be 40% of the financing either. It could be something in between. The Talcan Samruk TKS JV was helpful with the initial licenses with Vancouver. Have there been any discussions or scope for them to get involved about the development route? That's a good question. Not yet, I would say is the answer. We've been putting everything off ultimately until we get drill results in place. And as I mentioned before, people can literally come and inspect the core as well as the results and start to make a decision for themselves. Once we've been able to demonstrate, which we can now do, our suspicion that we have the potential to develop a profitable open pit mine, now is the time to start all of these conversations. So thanks for the reminder. I'll add Talken Samaruk of the list of people to call, to commence those conversations. Okay. Given the positive recent results, can you expand on the plans for Rudney? Are there any factors which will influence the design? Well, I think. Thanks, Stephen. I think I've touched on that, so I'll just summarise it again. Yes, I mean, further drilling will influence the design. The initial concept which AMC put forward was a 5-year mine life at 1 million tonnes per annum. We need to see if you could sell and process 1 million tonnes per annum if we're doing a mine gate sale. So Cas Minerals, which is the Nikolskoye concentrator, has 600,000 tonnes of spare capacity today. So if we produce 1 million tonnes, can we process the other 400,000 tonnes elsewhere? That's an example of a consideration. Or maybe they'll have 1 million tonnes per annum, but in a couple of years' time, and we can send the whole lot to one place. So the drill results will obviously dictate the mine plan, the pre-strip. It'll dictate everything that'll give us that information. And again, the design being the economic trade-off studies of what can you do to upgrade that ore? Are you selling 1 to 2% mine gate ore, or are you selling a higher percentage concentrate, depending on the capex required to get there? So good question, but a little bit too early to give much more detail than that today. Simon C, how do you manage quality assurance of the assays, as you mentioned the potential to re-assay the high-grade samples? So we're vehement on QA/QC, which is actually why you might all be aware why our recent assays took longer to release that to market. So we sent the first batch of assays to ALS, and ALS are the global standard in assay techniques. They're a certified lab. They're all over the world. And if you want to ensure the best quality results, ALS is unequivocally one of only probably 2 or 3 brand name labs in the world that you ensure your results get sent to. So there's no better lab in Kazakhstan for that purpose. To that end, we sent the first batch, which had top cuts or top grades of 1% for copper and zinc. We have more than 62. We had 62 samples that needed to be sent that were above those cutoff grades. And when we send those, we send 3 sets of standards, which is as a percentage of them, which I outlaid in our announcement. So they're what we call blanks, which is building material, not supposed to have any copper, lead, zinc, gold, silver in it. We send duplicates. So that's the same piece of core, crushed, blended, split, and sent, which ultimately means it should have a very similar result. The two samples should have a very similar result. And we send CRMs, which is called certified reference materials. So those 62, when they came back, we had 1 certified reference material which came in 30% below the expected number. Now, this is quite a rare event for labs, but nonetheless, when it happens, we need to pick up on that. So I think it was incredibly good that our team did pick up on that. And then we go through a process of confirming the assay results with another set of samples. So from those 62, we sent 10 samples, including that CRM, back to the lab. Now, of those 10 samples, the CRM came back correct within the required limits. So it was obviously an error in the first round. And 9 of the other samples came back slightly above their previous assay method. Not a hugely significant amount. We said in the announcement it was up to 10%. I believe the average was closer to 4% above those grades. And so we are actually looking at reprocessing the whole 62. I don't think the number is going to be completely game-changing, but ultimately we'll get more accurate data, which will be used for resource modelling. So what I'm hoping for is a slight bump up in the grades, but not anything hugely significant. And then obviously we'd look to be adding the gold as well, because we're waiting for the gold assays to come back. So our QA/QC, I think the fact that we've gone through this process demonstrates that our QA/QC processes are absolutely on point, world class, and can be expected to meet any standards from anyone looking to do due diligence on us as a company. Good question. Why do you think the market does not value the shares given the potential value within the company? Oh, Christopher, I'm not sure. I'm genuinely not sure. I'm consistently perplexed by the share price reaction, which might not be the answer you're really looking to hear. I'm very, very perplexed by the share price reaction. For me, the risk-reward scenario for eStar has dramatically shifted in favour of the company on these results. And that is a lot to be said. When I mentioned before, 40 to 80 times on a net present value upside potential, which we could potentially put those numbers on. It's not without risk, but it's dramatically shifted in our favour. What I will say is that the board and the management are consistently reviewing why this is the case, and I think that certainly over the Christmas period, we need to do a real strategic analysis about our messaging, about our communication, to see if it's something that we're doing, which again we constantly revisit. But I think a real strategic review of our messaging and our communication to understand why that's the case, because to me it's mind-boggling. So I need, while we're not drilling and we're doing a little bit less work operationally, and the geologists have their longer term tasks in preparation for next drill season, I think that's a really good time for me to do some inward revision to see what we can fix to change that for next year.
Perfect. Alex, I think you've actually addressed all of the questions from investors, and of course the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to yourself and the company, Alex, could I just ask you for a few closing comments?
Certainly. Well, once again, I'll say, everyone, thank you very much for your time today. I really appreciate your interest in eStar and you taking 40 minutes of your day and listening to me talk about the potential here. The summary here, I guess, is threefold. One is copper. Even if it's not eStar, make sure you get some exposure to copper. I believe in the next 12 months, undoubtedly that surplus surplus copper situation is going to come forward from 2027, and it could come forward as early as next year. So you can be a little bit early in moving in these things, but when it does happen, it'll happen fast. And I think uranium and lithium in the last sort of 24 months with share prices of those stocks have demonstrated that. This is not a supply deficit that can be met easily. There is not big giant copper mines just waiting for a slightly higher price to come online. This is something that will be systemic and long-lived, and you need to make sure that you've got exposure to that. The second thing will be the risk-reward for eStar. As I said, very much now in favour of eStar. Their market cap is a fraction of the value of the potential value of the asset, and we intend on demonstrating that in 2024 with drilling and with genuine economic studies. With that might come certain corporate events. We'll have to see how that plays out. But nonetheless, there is copper in the ground. It's shallow. The grades are outstanding. So there's something very, very exciting to be chasing here. And then the third thing is the potential upside. We are still de-risking or advancing our earlier stage exploration assets to drill ready. Any one of these could be another 30 to 50 million tonne at 4 to 5% copper mine, and that's in and of itself is $1 billion asset. So we're doing the lower risk work in assets like Vakuba, slightly higher risk in assets like Talovskoy, and then the more greenfields exploration, which I'm calling the medium term targets, hopefully drill ready towards the middle to the end of the drill season. So there's a lot to be excited by for eStar for next year, and I would love to have you all along for the ride. it'll be great.
Perfect. Alex, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of East Star Resources PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thanks.